In this week's video, we'll cover an extremely bullish signal that has only been flashed 6 previous times in the last 38 years. We'll kick off the video by taking a look back at calendar year 2019. We're all human beings, and thus we all tend to suffer from recency bias. And as a result, since the market's done very, very well in 2019, it might be very, very easy to forget how difficult Q4 of 2018 was. Clients and regular viewers may remember when the market was up here on October 3rd of 2018. Historically, it was a very low probability event relative to seeing something like this, which is actually what unfolded in Q4. And a year ago in these videos, we indicated in no uncertain terms that we were not pleased with the way that we handled this low probability decline. But let's assume that we handled this decline perfectly. If we had done that, we still would have been in a very, very defensive posture down here on December 24th, 2018. And everything that we talk about in this week's video is actual performance. Our real-world actual allocation on December 24th, 2018 was about 82% cash, about 18% bonds, and 0% stocks. And that was absolutely positively the right place to be based on the facts that we had in hand on this day. On December 24th, 2018, the Fed had basically just told the markets up here that it was no longer going to support the markets with the Fed put. The CNBC article dated December 20th, 2018. And at this point here, we have no idea if the Fed is going to capitulate in 3 days or in 3 years. To illustrate some basic concepts about risk management, let's assume that we had $1 million invested when the market peaked on September 20th, 2018. And let's assume from this point here, when we had $1 million, our stance was we're buy and hold investors, and if the market falls, we're not going to take any action. What many buy and hold investors don't understand is just how bad it can get in the stock market from a historical perspective. If the decline from the September 2018 peak was the same as the roughly 28% drop that took place in the real world in 1961, our $1 million would have been reduced to 720,000, and the S&P 500 would have fallen from roughly 2925 to down in the neighborhood of 2100. A similar situation in the 1980 case, except our 720,000 would have dropped to 714,000. But we're buy and hold investors, and we're going to wait it out. Would have been 703,000 if we saw what happened in 1946. Our $1 million would have been reduced to 640,000 if we were buy and hold and experienced the same peak to trough decline that investors saw in 1987. At this point, it gets very, very difficult to be a real-world buy and hold investor because it's very, very painful. Our $1 million is now down to 627,000 if we saw a decline similar to what happened in 1968. The real-world decline in 1916 was over 40%, and thus our $1 million would have dropped below 600,000, and the S&P 500 would have dropped from roughly 2,900 to 1,750-ish. But we know the stock market always comes back, so we're just going to hang in there. If we experience something similar to what happened in 1901, our $1 million would have dropped to 538,000. 1919 would have dropped to 534,000. 1909 experienced a 47% drop. Our $1 million would have been down to 528. 1906, 514,000, and the S&P 500 would have dropped from 2,900 below 1,550. The 1973-74 bear market was extremely painful. Our $1 million would have been reduced to 500,000. The peak to trough decline in the 2000 to 2002 bear market was over 50%. We'd have been down to 494,000. and we would have sat there and watched the S&P 500 fall from 2,900 to 1,450-ish. When the stock market peaked in September of 2018, if we experienced a similar decline to what happened in the financial crisis bear market, roughly 57% from peak to trough, we would have watched the S&P 500 fall from 2,950 to about 1,250, and our $1 million would have been reduced to 423,000. But we know the stock market always comes back. In 1937, it got even worse. Our $1 million would have dropped to 400,000, and the S&P 500 hypothetically would have been knocking on the door of 1,150. And in the present day, many investors don't know this, but in 1929, the Dow dropped over 89%. So if we were implementing buy and hold properly, which means you hold, our $1 million would have been reduced to $108,000. And this illustration tells us why at some point you have to reduce your risk. In the real world, we were out right here where my cursor is. At this point here, we're in 82% cash and roughly 18% bonds and totally out of the stock market. Under our approach, and we're not saying our approach is the correct approach, we want to try to protect capital so we can live to fight another day. And this will illustrate one of the reasons why we want to do that. Let's assume the S&P 500 dropped 50.51% from the peak in September of 2018. This is the magnitude of the decline from peak to trough in the 2000 to 2002 bear market. Thus, the S&P 500 would have dropped from roughly 2,900 to somewhere in the neighborhood of 1,500. And that means the market would have moved back to the same level that it was sitting at in the year 2000. And that means a buy and hold investor could have seen 18 years of investment gains wiped out in less than 3 years. Where do we get in less than 3 years? Because it took less than 3 years for the S&P 500 to decline 50.51% in this bear market. This is where the S&P would have been sitting hypothetically, and that's the exact same level it was trading at in the year 2000 where my cursor is. If we saw the same decline from this peak here in September of 2018, which was 57.69% in the financial crisis bear market, we would have given back 19 years of S&P 500 gains. The market would have dropped to this level here, which is the same level it was trading at in 1999. If we decided to do nothing up here, we're buy and hold, we're going to hang in there. We saw a decline similar to the decline that took place from 1929 to 1932, which was an 89% plus decline. We would have seen the S&P 500 move back to this level here where the pink line is, and an investor would have given back gains basically for 27 years because the S&P 500 would have moved back to the same level it was in 1991. This sounds extremely painful, dropping back to this level here. This real-world example, because this decline happened in the real world, was even more painful, and it's really easy to understand why people were so distraught after the 1929 crash and near the 1932 low. There is a way to avoid this, there is a way to avoid this, and there is a way to avoid this. It's called hitting the sell button. And if you're a client, we've just shown that when a devastating bear market comes, we will take action. And once again, it's easy to forget in the present day when we're down here on Christmas Eve. The Fed is basically in a stance that I hadn't seen during my entire career. From a risk-reward perspective, it made sense to take defensive action up here. And from a historical perspective, it made sense to take action up here. So really, our question for 2019 is, did we execute properly walking forward from here? If we fast forward a little bit into Q1 of 2019, Financial Times, January 4th, 2019, better late than never, Chairman Powell. On January 4th, the Fed pulled a 180. And we're not talking about this with the benefit of hindsight. During the trading session on January 4th, 2019, we said Fed's Powell throwing markets a bone. This was a significant shift, a change in the evidence. And maximum flexibility says we have to respect the new data that we had in hand on January 4th. And roughly a year ago, on January 21st, 2019, we now had a significant and rare breath thrust in the history books, and it told us to be prepared to add to our equity exposure in the coming days if the hard data and observable evidence can continue to improve. And as we walked forward from this low here, we were already leveraging some of the bird strike research that we had conducted. So in order to help us manage risk and reward, on January 11th, 2019, in a weekly video, we covered the bull-bear roadmaps. This is what the stock market looked like on January 10th. Walking forward, these are the type of looks that we wanted to embrace, respecting that it wouldn't be unusual for the V-bottom to have a retest, a retest, a retest, and a retest. We also covered these charts on January 11th, 2019, respecting that a rally off the low could have been followed by really, really bad things. It's hard to make the argument that the market on January 10th, 2019 looks discernibly different from this point here and this point here. From here, the market plunged into October of 2002. From here, the S&P 500 fell from 1275 down to that Damien low of 666 in March of 2009. Thus, it's not prudent, based on the evidence that we had in hand here, to throw all caution to the wind. At a low, our game plan is to incrementally add to our equity exposure as the data improves, and that's exactly what we did. And given that on December 24th, 2018, we had no exposure to the stock market, and given that we respected this still vulnerable look here on January 10th, 2019, we're very, very pleased with our full-year returns of roughly 16.37%. This is the average gain for all accounts that were with us for the full year. The median gain looks very, very similar at 16.34%. We just showed what can happen if you never manage risk. Every single one of these lines represents a real-world decline, something that happened before. Thus, when we look at these figures, it's logical to ask, how do these results compare to other firms that also manage downside risk? Bridgewater has some of the brightest minds on Wall Street and is largely considered to be the most successful hedge fund of all time. How did Bridgewater do relative to these numbers for full year 2019? Their pure alpha fund was down 0.5% for the year. And the average macro hedge fund manager, which is basically what we do, we look at everything and can invest in everything and make decisions based on what we see. The average hedge fund that does the same thing was up 6.4% in 2019. And the average of all hedge fund managers was 6.96% relative to our 16.37%. And why are some of these numbers relatively low? Again, it's easy to forget, but the consensus for the most part during the entire year 2019 was for really bad things to happen. Our model and the data that we track and the data that we covered in the weekly videos last year continually told us to keep an open mind about better than expected outcomes. A fair rebuttal would be, but Chris, buy and hold, S&P did 28.88%. That's true, but there's three very important words on this page: buy and hold. And buy and hold only works if you hold 100% of the time. So if this return here looks very, very appealing to you, then you also have to accept that you would hold through this little slideshow here. Keeping in mind, in the real world, we were 100% out of the stock market here. Relative to what we just saw, this starts to look very, very good. If you've been around the markets for any length of time, at some point you've run across this question. Why would anyone give their money to a hedge fund or money manager when buy and hold is so hard to beat? Because the harder you have worked, the longer you have worked, the more money you have, the larger your pension fund, or the larger your endowment fund, the more you understand, respect, and want to avoid the bound to happen again and only a matter of time, devastating and life-altering losses that occur periodically under a buy and hold approach. If something like this happened before, if something like this happened before, and something like this happened before, it absolutely, positively, and most likely will happen again. We just looked at this number relative to these numbers here from a historical context and from a bearish perspective. Now let's look at this number relative to this number from a bullish perspective. How concerning is it after a major low that we underperformed by 12.51%? And that's this number minus this number. How long did it take for the market to move 12.51% above the low? Not very long. We had a very rare V bottom here. We moved 12.51% off of this low by January 18th. Unless we're willing to guess and cast all the data aside and throw all of our chips to the center of the table, it's not surprising at all that we missed some of this upside here. As the creator of the market model, it's not only not surprising, it's to be expected. Missing this move here and this 12.51% has to be viewed in this context. In this context and in this context. Our purpose here is not to criticize buy and hold. Buy and hold works. It's not really a debatable topic. But this statement here is also undebatable. Buy and hold only works if you hold 100% of the time. You can't call yourself a buy and hold investor and say, well, if things got really, really bad, I'd get out. Some FAQs that might help on this topic. You can find these on our website. How long can it take to get back to break even? Another FAQ. Will a diversified mix of ETFs and/or mutual funds save me in a bear market? Will dividend stocks save me in a bear market? And as always, these questions are answered on the website with facts, no opinions. If you doubt any of these headlines here, you can ask someone that held all the way to the lows in March of 2009 and then finally said, I can't take it anymore, and they sold out, and it took them years to get back in. The examples that we just walked through. If the stock market in 2018 fell this far, and this far, on average, based on that peak, an investor would have given back 21 years of gains. Let's put that in the proper context. That means, hypothetically, if you were 39 years old at the peak in 2018, you could have given back gains and your portfolio would have looked similar to what it looked like when you were 18 years old. If you were 50 at the peak and held, when it was all over, your portfolio would have looked similar to what it looked like when you were 29 years old. And if you were 67 years old, you would have walked back to what your statement looked like when you were 46 years old. Taken in this context here, this is starting to look like a pretty good trade-off. We've looked at the negative side of the ledger. Let's try to answer this question. How concerning is it to miss the first 12.51% after a major low in the context of the bullish perspective? We've made the case with facts that this low here looks like a cyclical low that has occurred within a secular trend. These are all cyclical lows that occurred within a secular trend. These are all cyclical lows that occurred within a secular trend. Therefore, at the cyclical low in 1960, how concerning would it have been if you missed the first 12.51% off of the low? The only way that we can answer that question is to understand how far the market rose after the cyclical low in 1960, and the answer is 130%. Now we'll take a look at the same question from this low and then this low. How concerning was it to miss the first 12.51% after the low in 1957? From our perspective and our knowledge of history, not really concerning at all. Should we have lost sleep if we missed 12% off the low in 1953? Only if we were extremely greedy, given the fact that the market rose 429% from that low. Now let's ask and answer the same question from this low, this low, this low, and this low. From the 1994 low, the S&P 500 gained 243% before it reached the secular peak in March of 2000. From the 1990 low, missing 12.51% would not have been all that concerning given the market gained 418%. From the 1987 cyclical low that occurred within a secular trend, the S&P 500 gained 582% before the secular peak was reached in March of 2000. And our demographic research told us that the present day looks similar to the 1984 to 1986 window. How far did the market move from the cyclical low in 1984? Answer, 933%. To summarize, we're looking at this low, this low, this low, this low, this low, this low, and this low. The average gain from the cyclical low was 421%. The median gain from the cyclical low within a secular trend was 418%. Which means we could ask, would we have been upset if we only made 408%, which is 421% minus 12.51%? We've talked about this a lot, so we'll move quickly here. What about valuations? This question always comes up. And if we would have presented gains like that in 1982, the exact same question would have come up. Because in 1982, on December 31st, if we look back to 1881, the median Shiller PE was 14.83. And given the fact that major lows had recently occurred with a Shiller PE of 8, 9, 8, and 7, stocks looked expensive in the rearview mirror in 1982. And just as in the present day, nobody has any idea what the Shiller PE will look like 20 years down the road, and nobody in their right mind would have guessed that the Shiller PE would have moved from 14.83, the median level in 1982, to 44 at the market peak in 2000. We could have made the argument that stocks looked expensive from this point all the way to this point. In this portfolio here, this allocation here, $1 million portfolio would have turned into over $9 million. In the entire move, stocks looked expensive, very expensive relative to the median Shiller PE that we knew in 1982. From a bullish perspective, we asked, would we be upset making 408%? I don't believe any of us would say that we would be upset making over 400%. But I'm guessing almost every one of us would be very upset, sick, depressed, if we gave up 21 years of gains. How could you possibly give up 18, 19, 27 or an average of 21 years of gains. If you continually said, I don't want to miss the bounce, the market's going to bottom soon, if I hang in there, it'll be okay. The market always comes back. I'm diversified. I own dividend stocks. My utilities will save me. I have a pie chart, etc., 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 etc. And you might argue, you cherry-picked 3 of the worst cases. Not true. Out of the cases that we covered, 8 of them, 1, 2, 3, 4, 5, 6, 7, 8. 8 of them would have wiped out gains all the way back into this area here. It's not a question of if something like that will happen in the future. It's simply a question of when. Let's shift gears now. Might be helpful to answer this question. Do the facts in hand favor something like this happening? Or do they favor something like this happening? To help us answer those questions, let's review a hot off the presses S&P 500 signal. This is similar to one of the topics that we covered last week, so we'll move quickly. As of December 31st, 2019, the NYSE Advanced Decline Volume Line monthly printed 2 consecutive monthly closes above this upper Bollinger Band here in blue. How many times has that happened since 1981, and what can we learn from it? Notice the cases that we're looking for here. We can see discernible white space between the indicator and the band. Discernible white space. 1982. Discernible white space. 1985. Discernible white space in the present day. Discernible white space here in 1991. Discernible white space, 1995. Discernible white space, 2003. This look here, similar to this look here. Bollinger Band center line turning back up. Center line turning back up. End of September 2009, discernible white space. This is a similar look to what we just experienced at the end of December 2019. And this period is close. We have a basing pattern here, a rally, and then a move above. We don't really get the discernible white space, so it doesn't check all the boxes. We just went through every example between calendar year 1981 and 2020. And it's interesting to note, out of these examples that we just went through, they occurred after the major low in 1982, after the low in 1984, after a major low in 1990, after a major low in 1994, major low in 2003, major low in 2009, and a major low in 2013. And these periods up here that we just went through, the ones that occurred within a secular trend, 1982, 1984, 1990, 1994, 2009, 2013. Thus far, not one of these lows has been revisited. And that is why we're referring to them as a major low, a major buying opportunity. This looks like a major low and a major buying opportunity. And based on the evidence that we have in hand, it looked like an excellent time to add to our equity exposure. And the facts that we have in hand tell us that these numbers could look relatively small relative to what could happen over the next 5 years. This chart that we've referenced several times, every time we've referenced it, it's been dated October 25th, 2019. And all of these things that just happened in the present day relative to these historical cases are highlighted here. And they thus align with the theory that we presented on October 25th. But we didn't have that evidence in hand. As of October 31st, this is what this chart looked like. This is what it looks like today, telling us that the hypothesis that we covered on October 25th helped foretell phenomenon which have not yet been observed. This chart told us to be open to this chart morphing into this chart. Since this signal just went into the history books 10 calendar days ago, it's logical to ask, what happened next in the 6 historical best fit cases below? This isn't a best fit case. Can't check all the boxes, so we're going to throw it out when we answer this question. Notice this. Look how small these charts are. See how easy it is to see the white space in every single case? Not the case here. This is unusual and rare, and thus understanding how the S&P 500 performed walking forward from these periods here should prove to be very, very helpful from a probability perspective. Performance walking forward the first 4 months tells us to have realistic expectations about normal and 100% to be expected market volatility. But the long-term outlook aligns with everything that we've been talking about since the breadth thrust low in January of 2019. If we're in a secular trend, and this is a cyclical low within a secular trend, we would expect the stock market to be higher 1 year from now, 2 years from now, 3 years from now, 4 years from now, and 5 years from now. And that's exactly what happened after the 1984 low. That's exactly what happened after the 1987 low. That's exactly what happened after the 1990 low. And that's exactly what happened after the 1994 low. Once again, facts that we have in hand tell us to keep an open mind about much better than expected outcomes. And it should be noted that these dates that we're walking forward from are similar to walking forward from 10 calendar days ago. Before we close, let's answer this question. Pushing egos, emotions, and opinions aside, does January 2020 look more like the rare bullish cases or the 16 largest decline cases? Remember, we opened the video with these charts here. All of these periods are in this table here. The average decline was 46% in those 16 cases, and the median decline was also 46%. The average loss on $1 million portfolio from peak to trough was significant. The median loss, significant. These are the type of periods we want to avoid. These are the type of periods we want to embrace. Let's compare these periods here to the present day. We don't have monthly MACD data for 1901, so we'll start with 1906. This is the net aggregate opinion rolling over in a bearish manner in every single case. This is a bearish MACD cross on a monthly chart in every single case. This is 1906 up to 1929. The same exact comments apply to the 1937, 1946, 61, 68, and 73 peaks. This is a look we want to avoid. Exact same looks, 1980, 1987, 2000, and 2007. So the $1 million question is, since all of these looks are similar, does the present day look anything like these concerning rollover periods, where the net aggregate opinion of all market participants flipped over from bullish to bearish? The answer is the present day doesn't look anything like any of these cases. 2020, we just experienced a bullish cross. Doesn't look like any of these cases on the screen between 1906 and 1929. And the present day, the facts that we have in hand on January 8th, doesn't look anything like 1937, 46, 61, 68, 73. And the present day doesn't look anything like the rollover in 1980, 1987, the peak in 2000, or the peak in 2007. Said another way, the present day doesn't look like any of these periods in this table, and doesn't look anything like the periods that we covered at the top of the video. Since we believe we're in the relatively early stages of a secular trend in the present day, how does the present day look compared to this period here, this period here, this period here, and this period here. All four of these periods are at the relatively early stages of a secular trend, the relatively early stages of a secular trend. If this hypothesis holds water, we would expect the chart in 2020 to look similar to the chart after the low in 53, 57, 84, and 87. This is what those charts looked like after the market bottomed and rallied. We've already determined that the present day doesn't look anything like the concerning cases. And now we've determined that the present day looks a lot like, almost identical to the cases that we want to embrace and the cases that we've been covering in these videos for several weeks. There's another takeaway here. You hear a lot in the present day, the market's going straight up. Could have said the same thing in 1954. The market's going straight up. 58, we're going straight up. 85, we're going straight up. 89, we're going straight up. Every single one of those cases proved to be an outstanding buying opportunity near the cyclical low. And every single one of those cases, those lows were never revisited. The facts that we have in hand align with everything that we've been covering in recent weeks and months, and the facts that we have in hand from numerous perspectives. This is just a way to summarize the weight of the evidence, and this is just a way to summarize the weight of the evidence. The facts that we have in hand in the present day align with everything we've been talking about in recent weeks and recent months. And the facts that we have in hand in the present day contradict wholeheartedly the thesis or theory that we're about to make a major top. Is this look here subject to change? Absolutely, positively, yes. But it hasn't changed yet. All of these bullet points remain relevant, including the only way any of this works is if we walk forward with maximum flexibility, take it day by day, and we don't make any assumptions about what's going to happen in the future, nor do we make any assumptions about what the data may look like tomorrow. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.